The International Monetary Fund.
Yeah.
You've probably heard the name, right? Seen it in the headlines. Maybe it's come up in meetings.
It's definitely out there.
But beyond just the acronym, what is the IMF, really? Is it, this global financial firefighter putting out economic crises?
Or is it something more controversial? That's often the question.
Exactly. Is it imposing these really tough conditions that critics, well, they say do more harm than good?
It's a complex picture, for sure.
Okay, let's try and unpack this. Today, we're doing a deep dive into the International Monetary Fund. We're drawing heavily from a pretty comprehensive backgrounder by the Council on Foreign Relations.
A good source. Very detailed.
Yeah, and our mission isn't just, listing facts. We want to cut through some of that complexity, understand where it came from, its origins.
Which are pretty profound, actually.
Right, and how its role has evolved, and, crucially, the challenges it's facing right now.
Which are significant.
So whether you're tracking global finance day to day, or you're just, really curious about how global power works, get ready for maybe some aha moments about one of those impactful and, often debated organizations on the planet.
Definitely influential.
So to really get the IMF, we need to rewind a bit, go back in time. Picture the world, 1944.
Right after World War II. Or, as it was ending.
Exactly.
Yeah.
The world's reeling from devastation. Nations aren't just rebuilding physically. They're desperate to avoid another, global economic catastrophe.
Like the Great Depression, which men felt contributed to the war itself.
Precisely. That kind of economic collapse.
And what's truly fascinating there, I think, is the sheer ambition. You had 44 allied nations gathering at Bretton Woods.
Bretton Woods, yeah.
And they weren't just thinking short-term fixes. Their goal was huge. Build a whole new post-war financial architecture.
Wow. Not just patching things up.
No, not at all. It was about economic cooperation, stable exchange rates, a system designed, really, to foster sustainable growth.
And improve lives.
Yes, ultimately lift living standards, reduce poverty. And the IMF was born right out of this vision. Its initial job: manage this new global system of fixed exchange rates. Make sure international payments flowed smoothly. Think of it like the meticulous accountant for the world economy.
Keeping the books balanced, globally speaking.
Kind of, yeah. Making sure everyone played by the agreed-upon rules for currency.
So it started as this maybe quieter but really essential overseer.
Absolutely. Foundational.
But, well, the world doesn't stand still, does it? The early 1970s, things started to shift.
Big time. Especially after 1973.
Right. That's when President Nixon suspended the dollar's convertibility to gold.
Which effectively blew up the fixed exchange rate system Bretton Woods had created.
So that core job description for the IMF
Yeah.
suddenly obsolete. How did that change things?
It was a dramatic pivot, a really fundamental shift. With fixed rates gone, the IMF couldn't just be that accountant anymore.
You needed a new role.
It had to become much more active, almost like a financial first responder. Or paramedic, as you said. Its focus shifted heavily towards surveillance, keeping an eye on global economies, and, critically, towards supporting developing countries.
So that's when the focus on developing nations really ramped up.
Yes, particularly those starting to grapple with big debt crises. That's where its role as a watchdog really solidified. It started acting as that lender of last resort.
The safety net.
The safety net, exactly, for when national economies were really faltering.
That's a really important distinction to make because I think a lot of people hear IMF, World Bank, and they kind of blur together.
They do. It's a very common point of confusion.
Can you clarify that unique, sort of evolved IMF role for us, especially compared to the World Bank?
Absolutely. Both were born from Bretton Woods, yes, but their mandates went in different directions.
Okay.
The World Bank focuses mostly on long-term development projects, funding infrastructure, poverty reduction programs, things like that, through loans and grants.
More project-based.
Exactly. The IMF, on the other hand, is truly the watchdog for the global monetary system. Exchange rates, international payments, financial stability, that's its core turf.
Got it.
Its main job is ensuring the stability of that whole international system. You can maybe think of it like a global credit union for its 190 member countries.
A credit union. How so?
Well, nations contribute funds. These are called quotas, based roughly on their economic size.
Okay, the quotas, I've heard of those.
Right. And these quotas aren't just an entry fee. They determine a country's voting power within the IMF.
So more money, more say.
Essentially, yes. And importantly, the quotas also determine how much financial help a country can access if it gets into trouble.
I see.
So it's a structure designed to pool resources, provide a collective safety net, but yeah, it inherently means wealthier nations have more influence.
That power dynamic, based
Mhm.
on the quotas, definitely something to keep in mind as we go. But first, let's get into the nuts and bolts. How does this global watchdog actually, do its job day to day? The CFR backgrounder mentions three main ways.
Precisely. Three core functions. First, there's surveillance.
Surveillance.
Huh.
Sounds a bit ominous.
Huh? Well, it just means that IMF formally monitors the global economy and the financial systems. They do regular checkups on member countries' economies.
Like an economic physical?
Sort of, yeah. They analyze fiscal policies, exchange rates, financial sector health, everything. And based on that, they offer macroeconomic and financial policy advice.
Advice. Is it binding?
That's the key. It's generally non-binding advice, but it's meant to be an early warning system to spot potential problems and hopefully prevent crises before they even happen.
Okay, so it's proactive advice. But how does that land with, sovereign nations, someone from outside telling you how to run your economy?
That's exactly the tension, right? But the IMF's influence comes from its perceived expertise, its global perspective, and, let's be honest, implicitly, from its role as a potential future lender.
Ah, okay. So countries might listen because they might need help later.
Often, yes. They tend to take the advice seriously. Okay, second function, technical assistance.
Technical assistance, what does that involve?
This is much more hands-on, more practical. The IMF provides support and training mostly to low and middle-income countries.
Like what kind of training?
It could be training central bankers on monetary policy, advising finance ministries on tax reform, helping strengthen financial regulations. Basically, building up the local institutional capacity for sound economic management.
So helping them build better systems themselves.
Exactly. Capacity building.
And then the third function, maybe the one that gets the most headlines, lending.
Indeed. This is where the IMF steps in as that financial crisis firefighter we talked about.
Things go really wrong.
Exactly. When a member country faces severe economic problems like a balance of payments crisis where they can't pay for imports or unsustainable debt or their currency is collapsing.
The IMF provides loans.
Yes. But crucially, these aren't long-term development loans like the World Bank might give. They're typically short to medium-term assistance.
Aimed at stabilization.
Precisely. Designed to help the country stabilize its finances, restore confidence among investors and its own citizens, and get back onto a path of sustainable growth.
And you can see this in the data, right? When big crises hit.
Oh, absolutely. The charts in the source material really show it vividly. Look at the 2008 global financial crisis or the shock from the COVID-19 pandemic in 2020. You see these massive spikes in IMF lending. It underscores its role in times of acute economic distress.
Okay, so the firefighter arrives with the water hoses, the resources.
Yes.
But they often come with a very specific and sometimes really controversial instruction manual, don't they? These loans aren't free money. They come with conditions.
You've hit on probably the most debated aspect of the IMF, the conditionality.
What kind of conditions are we usually talking about here? What's in that instruction manual?
Typically, the IMF attaches specific policy conditions to its loans. These are often called structural adjustment programs, or SAPs.
Right, SAPs. Heard that term.
They're policies designed to tackle what the IMF sees as the root causes of the country's economic problems. The idea is to get government finances back on a sustainable footing and restore investor confidence.
Okay, so what do they usually push for?
Generally, these conditions encourage governments to balance their budgets, often through fiscal austerity.
Spending cuts, tax hikes.
Yes. Also, removing state subsidies, privatizing state-owned companies, liberalizing trade and currency policies, removing barriers to foreign investment and capital flows.
The goal being?
The stated aim is to promote market efficiency, reduce government interference, and create conditions for long-term stability and growth.
On paper, I guess, some of those sound like standard economic reforms you might hear about.
They can, yes.
But history tells us these policies often trigger massive debate, even protests. What's the core of the criticism? Especially from people like Joseph Stiglitz.
Right. This is where we get into that deep dive into discontent. Critics and, yes, Nobel laureate Joseph Stiglitz is a very prominent voice here, especially with his 2002 book, Globalization and Its Discontents.
Hmm.
They've passionately argued against these IMF policies. They say, look, the intent might be good, but in practice, these strict conditions often backfire.
How so?
Stiglitz, for instance, argues that forcing fiscal austerity, cutting government spending during a recession, can actually choke off growth just when a country needs stimulus most. It deepens the downturn.
Right, seems counterintuitive.
And high interest rates, meant to maybe curb inflation or stabilize a currency, can make existing debt crushing both for the government and for local businesses trying to survive.
Okay.
Then there's the rapid, often forced privatization or trade liberalization. Critics say this can wipe out local industries and jobs that aren't ready for intense foreign competition.
Leading to social problems.
Exactly. Social unrest, rising inequality, and a feeling that key national assets are being sold off cheap, undermining sovereignty. So instead of fostering sustainable growth, the argument goes, it can sometimes worsen poverty and instability.
So the cure is sometimes seen as worse than the disease. I remember reading William Easterly, the NYU economist, also has strong words. He called some IMF interventions overly ambitious and intrusive.
Yes. Easterly's critique really hits on that idea of a maybe one-size-fits-all approach.
Imposed from afar.
Right. Dictated from Washington, D.C., potentially missing the complex, unique realities, the social fabric, the political constraints on the ground in a specific developing nation.
Is there a particular case that really illustrates this tension?
Oh, the Greek bailout after the 2008 crisis is probably the starkest, most widely discussed example. It's really illustrative.
Greece. Yeah, that was huge.
Greece received, at the time, the IMF's largest ever bailout package in 2010. It was, an astounding 3,200% relative to its membership contribution, its quota.
Wow. And the condition?
Extremely harsh austerity terms. Deep cuts to government spending, major pension reforms, significant tax increases.
And the impact on ordinary Greeks was, well, devastating, wasn't it? Deep recession, sky-high unemployment.
Exactly. A huge human cost. The social and political pressure was immense. So intense, in fact, that Greek voters actually rejected those austerity terms in a national referendum.
They voted no. I remember that.
They did. But under incredible international pressure, particularly from European partners, the Greek government ended up implementing the measures anyway.
And the economic results?
Well, if you look at the data even now, Greece's economy still hasn't fully recovered to its pre-crisis GDP levels. It's sparked, and continues to spark, intense debate about whether those severe measures were effective or even appropriate.
But then there was a twist, wasn't there, with the IMF itself?
Yes. And this is the real aha moment, I think. Later on, the IMF itself started advocating for debt forgiveness for Greece.
Really? After imposing the austerity?
Yes. It was a pretty rare public moment of introspection. An acknowledgement, perhaps, that the initial medicine had been too strong, that just demanding austerity without sufficient debt relief could actually suffocate an economy entirely.
And that put the IMF in a tricky position with its European partners, right? The famous Troika.
Absolutely. The Troika, the European Commission, the European Central Bank, and the IMF was meant to be this united front managing the bailout.
But they disagreed.
The IMF's push for debt relief highlighted a growing internal shift, clashing directly with the more politically constrained views of its European partners. They were worried about setting precedents for other indebted Eurozone countries.
So it revealed some deep philosophical differences even among the rescuers.
It really did, and it showcased a potential learning curve within the IMF, maybe moving away slightly from rigid austerity towards a more nuanced view that includes debt sustainability.
Okay, so let's fast forward. Thinking about the IMF today, what are the really big challenges it's wrestling with now in our, well, very rapidly changing world?
Well, if you look at the bigger picture, we're unfortunately seeing a major comeback of debt crises.
Really? Again?
Yeah, and it's been massively exacerbated by a sort of perfect storm of events recently.
Like what?
The COVID-19 pandemic, obviously huge economic disruption. Then the war in Ukraine, adding energy and food price shocks, all leading to high interest rates globally, soaring inflation.
And this hits developing countries hardest.
Especially low-income countries. It makes their existing foreign debt much, much more expensive to service, particularly as their local currencies often devalue against the dollar. Their budgets are stretched incredibly thin.
Just keeping up with interest payments becomes a struggle.
Immense struggle. Forget investing in health or education.
So how is the IMF, with its, traditional tools, responding to this new wave? especially when challenges like pandemics or, say, climate change don't really fit the old financial crisis playbook.
It's definitely trying to adapt. First, capacity. The IMF has significantly boosted its firepower. Its lending capacity nearly doubled back in 2012, and by 2023, its total lending power is around $1 trillion.
$1 trillion, that's substantial.
It is. And they've also innovated some programs. For example, they doubled the money available through 2 specific lending windows designed for countries hit by natural disasters.
Okay, recognizing climate impacts more.
Exactly. But probably the biggest move, the most talked about one, was in August 2021. The allocation of $650 billion in special drawing rights, SDRs.
SDRs, right. Explain those quickly for us. They're not exactly cash, are they?
No, not physical currency. Think of them as an international reserve asset created by the IMF. Essentially, it's a claim on other currencies held by member countries, dollars, euros, yen, etc. They supplement a country's official reserves.
Okay, and this was the biggest allocation ever.
By far. A truly groundbreaking step intended to inject much-needed liquidity into the global economy struggling with the pandemic's effects.
But fascinatingly, while it provided that liquidity boost, it also kind of highlighted global inequalities, didn't it?
Absolutely. Because SDRs are allocated based on quotas.
Back to the quotas.
Right. So wealthier nations with larger quotas automatically receive the lion's share of these new SDRs.
Even though they probably needed them less than poorer countries.
Precisely. And that immediately led to calls from international aid groups and many developing countries for wealthier nations to rechannel or share their SDRs with countries facing more acute needs. It sparked a whole new debate about global financial equity and solidarity.
A powerful tool, but also a point of contention.
Definitely. And beyond liquidity and SDRs, we're seeing these fundamental shifts in global financial power playing out.
You mean China?
China is a huge part of it, yes. Since around 2017, China has become the world's largest single bilateral creditor nation.
Lending directly to other countries.
Exactly. Outside the traditional IMF World Bank structures, you have countries like Argentina, for example. It's the IMF's single largest debtor, owes them billions. But it's also borrowing significant amounts directly from China now.
So countries have other options, other sources of finance. Does that change the IMF's leverage?
It certainly complicates things. It raises really critical questions about the IMF's traditional influence, about coordinating debt restructuring when multiple major creditors are involved, including non-traditional ones like China.
And it fuels those calls for reforming the IMF itself, right? Giving emerging economies more say.
Absolutely. Given their growing economic weight, there are persistent calls for more representation for dynamic emerging economies on the IMF's executive board. The governance structure hasn't fully caught up with economic reality.
So it's not just about tweaking the financial tools, it's about the leadership structure itself. Are we seeing concrete proposals for reform?
Yes, very much so. There are powerful voices pushing for quite radical reform, actually.
Like who?
Leaders like Barbados Prime Minister Mia Mottley have been incredibly vocal. She, along with the current IMF Managing Director Kristalina Georgieva, who seems quite receptive, are pushing for reforms under banners like the Bridgetown Initiative.
Bridgetown Initiative. What's the core idea there?
These aren't just small tweaks. They're aiming for the IMF to really overhaul its offerings, to explicitly help countries adapt to climate change, for example.
Climate finance through the IMF.
Yes, integrating it much more centrally. Also, providing more comprehensive debt relief, going beyond traditional metrics, and even radical ideas like automatically suspending interest payments for countries hit by climate disasters.
Wow, automatic suspension.
Especially for those heavily indebted, low-income nations most vulnerable to climate shocks. It really highlights a potential evolution in how the IMF views its role.
Moving beyond just short-term financial stability.
Exactly. Moving towards encompassing these broader existential global challenges, climate, inequality, pandemic preparedness. It's asking a fundamental question. Can an institution designed for the post-World War II world truly meet the complex demands of the 21st century?
So, okay, let's try and pull this together. What does all this mean for us? Trying to understand this institution. We've traced this incredible journey. From its ambitious birth at Bretton Woods, the meticulous accountant of fixed exchange rates, then evolving through those dramatic shifts in the 70s to become the crisis firefighter.
A role it still plays.
Absolutely. And grappling constantly with the debates around its impact, the conditionality, the criticism.
The Stiglitz and Easterly points we discussed.
Right. It's clearly an institution that's had to adapt multiple times. Sovereign debt crises, global financial meltdown, pandemics, now climate change, geopolitical shifts. It's been through a lot.
It really has. And what seems undeniable is that the IMF remains right at the forefront of global economic crisis management. It's still the central player in many ways.
But the questions remain.
Huge questions remain. As experts from CFR like Brad Setzer and Stephen Paduano point out, there are fundamental issues still on the table.
Like what?
How do we actually resolve sovereign debt crises more efficiently and fairly, especially with new creditors like China involved? How do we manage volatile capital flows? And crucially, is the IMF, in its current structure, truly the best and most equitable way to channel vital resources?
Like those SDRs.
Exactly, like SDRs, to the countries that need them most desperately for things like climate adaptation or pandemic recovery. Its ability to balance that traditional mandate financial stability with these huge, complex, interconnected global challenges, that's what will define its future relevance, I think.
So given this incredibly complex history, its vital, constantly shifting role, and these growing calls for pretty deep reform, here's something to think about. How can the IMF best balance that core mission of stability with the really pressing, maybe even existential needs of countries grappling with debt, climate change, and all these geopolitical stresses?
That is the trillion-dollar question, isn't it?
It certainly is something to definitely mull over as you navigate your own informed perspective on global economics and the forces shaping our world.